in looking at the price here, we are up at some amazing territory here. We're right near the highs while this is being recorded. But if you look at this, the orange line is the 50-day moving average, and look at the support that it has given this all the way across. The green line is the 10-day moving average. And the 10-day moving average, you'll notice on uptrends like this, that it gives great support on uptrends, and when it breaks it, we're in a little pullback. Well, it's given great support now every once in a while. It's worked off its overbought condition. So now it's sort of free to run, and it looks like it is.
Silver has just ripped through a barrier that many thought would hold for decades. As of late 2025, spot silver has surged to roughly $54 to $55 per ounce, eclipsing the old all-time high and reclaiming its place on the global stage as a serious store of value. What we are witnessing now is not just a short-term swing, it's a structural break. The markets have spoken. After years in the shadows of gold, silver has re-emerged with strength, force, and conviction. This is not merely nostalgia for the 1970s or a replay of old silver mania. The macroeconomic environment today, chronic debt burdens, currency debasement, global monetary instability, makes silver's resurgence far more credible, far more sustainable. For investors wise enough to see through the noise, this moment represents a rare window, a chance to position ahead of a broad monetary revaluation that few mainstream voices are acknowledging. The age-old adage holds, silver is money, and money is being redefined. For those who have watched silently or waited on the sidelines, this is your moment. Silver has broken out of its long confinement. The 50-day and 10-day moving averages held firm, absorption occurred, and the breakout hit like a coiled spring released. The physical market, the demand for real metal, the global imbalance between supply and genuine demand, all of these forces are aligning now. This is not hype. This is a tectonic shift. What happens next could dwarf what we've seen so far. We are at the start of a new bull run, one driven not by speculation or manipulation, but by fundamentals: real demand, chronic undersupply, monetary debasement, and global uncertainty. And that is why what you are about to hear from Mike Maloney is only the beginning. In just a moment, we'll dive deeper. And later, you'll hear from Michael Oliver, whose macro-structural analysis will show just how high silver could go. If you care about preserving wealth and positioning ahead of the next leg, stay with us. Subscribe and hit the notification bell now, because this could be historic. We appreciate the support and hope you enjoy the video.
Wow, what a day! Trading was halted across many of the CME markets. This is a Chicago Mercantile Exchange. This includes futures, derivatives, currencies, and gold and silver. And right away after this happened, whether this is the issue or not, it doesn't really matter. I'll show you later. All the silver people came out and said it's silver that broke the system. They shut all of this down because silver is out of control. And that is a reasonable possibility. We've got very, very low stocks in London and so on. The supply-demand fundamentals for all of this is, so it was blamed on a cooling issue, that this data center had exceeded its capacity to cool. Now, there's some good evidence that may be the truth, but I'm going to show you later that it does not matter. But this was an exciting day, and there's some other things. Silver has basically done a breakout, so you need to watch this to the end. Anyway, we need to cool off the silver market, reposition to avoid silver exploding higher. So this is the translation, a cooling issue. Actually, I'm not sure if it was silver that caused this. I don't think so. But like I said, it doesn't matter. But all of the silver people came out and immediately attributed it to silver breaking the system instead of the system just breaking. Anyway, Gray Rabbit Finance, Hansa Czerny, and he could be right. Hansa has had some great information lately. Shanaka says that it wasn't the silver breaking the market. It wasn't a cyber attack. It was basically that. And by the way, 90% of global derivatives trading stopped. Not hacked, not manipulated. The cooling system failed in a single data center in Illinois. And he goes into the amount of power that this is sucking, and that these servers, this data center, was actually designed for 2015 capacity, and it really hasn't changed. And here it is, 2025, and the amount of data and processing going through this far exceeds it. But this is the tweet that I would like you to read. It is long. We will try to include the link at the end or down in the notes below. But silver's bull run hit a CME circuit breaker, but the cycle won't stop. And basically, Ben Rickert is putting out the evidence here of why this cycle won't stop. And the great part is down at the end here. He says, money is unraveling. He means currency here. Money is unraveling, confidence is eroding, price signals are returning, and silver, which is money, is the underestimated monetary metal. Monetary means money is leading the way. The bull run didn't pause, the exchange did. That tells you everything you need to know about where this cycle is going. And he has nailed it here. Please read his tweet. It's long, but it's not that long. It's going to take you 2 minutes. So now they haven't even started the shenanigans yet this month that they were doing last month and the month before. So this is from Nick Laird at Gold Charts R Us. On 9/13, gold margins were raised by 6.7%. If you remember back then, gold was moving first. Silver wasn't taking off yet. It wasn't breaking into brand new all-time highs like it is now. So that was 9/13. Then 9/25, they raised gold margins by 6.3% and silver by 6.7%. And then 10/9, they raised gold margins by 5.9% and silver margins by another 9.4%. Then 10/16, just a few days later, a week later, they raised gold by another 5.6% and silver by another 8.6%. And then on 10/23, gold and silver by another 5.3%. They haven't even started this shenanigans yet. You're going to want to hang on until the end here because I'm going to show you how this reflects on the 70s bull market. Now, in looking at the price here, we are up at some amazing territory here. We're right near the highs while this is being recorded. But if you look at this, the orange line is the 50-day moving average. And look at the support that it has given this all the way across. The green line is the 10-day moving average. And the 10-day moving average, you'll notice on uptrends like this, that it gives great support on uptrends, and when it breaks it, we're in a little pullback. Well, it's given great support now every once in a while. Gold and silver and almost everything else in the markets needs to come back and visit its 200-day moving average. But that is a much more rare event. So we've visited the 50-day 3 times here. We've visited the 50-day. It's worked off its overbought condition. So now it's sort of free to run. And it looks like it is. We've done a breakout. And this is we are over 3% above the previous highs here. And that is confirmation of a breakout. Here it is on my own website, goldsilver.com, 56.53. And then the main point, though, isn't to pay attention to all of the short-term noise. Yes, some servers probably overheated. It probably wasn't silver breaking the market, but I don't know that. I can't confirm it. Maybe it was silver, and maybe this is all an excuse. I doubt it. But because they didn't pull the other shenanigans yet. I'll get to some even greater shenanigans that they can pull when I do a comparison of today's market to the 1970s.
Looking back at the late 1970s helps put today's breakout into context. In 1979 and 1980, silver soared from roughly $6 per ounce to nearly $50, a staggering surge that rattled markets and triggered regulatory backlash. That rally ended in disaster when excess leverage, margin calls, and exchange intervention forced a collapse, an event now immortalized as Silver Thursday. The lesson then was clear. Silver's dramatic ascent was built on speculative excess and vulnerable leverage, and it collapsed just as dramatically under pressure. But the modern rally is fundamentally different. Today's surge is not being driven by one or two wealthy speculators cornering the market. It is being driven by real demand, structural deficits, and a global monetary environment that is increasingly hostile to fiat currencies. Silver is being forced upward by supply-demand mismatch, industrial demand, and institutional repositioning, not by concentrated leverage. In that sense, the 1970s episode serves as a warning, but the structure this time is far sturdier. The old vulnerabilities of margin-driven collapse have not yet been triggered, meaning the potential for a sustained, long-term ascent remains very real. Now, with that history behind us and the present setup so different, we turn to Michael Oliver's analysis, which takes the conversation beyond technicals and history into the structural forces shaping silver's future.
Well, silver has been a monetary metal as well, including in the U.S. at times, okay? So it's not the only monetary metal. There's other governments out there that are even looking at silver in that regard. But it will go up with gold. But the main point I'm making right now is it's just on the industrial side of silver, which it has, which gold doesn't have. The supply-demand for silver has been excess demand every year for like 5 years now. Supply can't meet the demand. And the demand is high-tech. Is all this AI talk we have, silver's involved in all of that in micro basis, but massive quantities. And it's also involved in solar. And solar is quite important in many parts of the world now where you don't have public utilities and so forth, but you're in Africa somewhere, or you're in remote parts of Asia, and the Chinese are satisfying that demand by creating solar cells. And solar panels with silver is essential in the silver cell process. And it's those two factors alone are just dwarfing the new supply of silver. And one of the problems with the supply of silver is that it doesn't come from silver mines. Yeah, so about a third of it does, as I understand, but most of it comes from base metal mining. And so the company that produces a lot of silver might not be primarily focused on whether the price of silver is up to increase their production of, let's say, magnesium or copper or something. It's not motivating them to increase production. Why? Because it's marginal in their overall operation. So that's sort of a unique situation for silver supply-demand issue. But as far as monetary metals, it has always been one. Don't forget that. And I do think that at the end of, not necessarily in the first 6 months, but a lot of that could reveal other factors out there as well, which I think will become exposed, that suddenly people start pulling their hair out saying, gee, I didn't expect that. Gee, I didn't expect that. One of the factors that we noted months ago, MSA did, is that Bitcoin was going to crash. And we got laughed at, of course, naturally. And the feverish investors in that market, a lot of them are young. Unfortunately, a lot of them are large corporations now, have gotten hip deep in the crypto market. It crashed. We went from 127,000 to 82,000 in a matter of 1 month to another month's low. Okay, that you call a crash. And I don't think it's over. You're having a bounce right now, but I think it's BS. I think ultimately you could see Bitcoin, which is like 57% of the crypto market, down in the 60,000 area in the next wave of decline. But it's already done its thing. It's proven to people, hey, what happened here? Well, I think the economic crisis that's about to hit, based on government debt crisis, not mortgages this time, okay? The U.S., the U.K., Japan all have huge government debt crisis problems. In fact, the president of the New York Fed, named Williams, was 2 weeks ago had a press conference or a speech or whatever, that I'm sure was approved by the Fed in general, where he said, we're going to start buying government bonds now. Quote him, government bonds. And his excuse was, no, it's, no problem there, but it's illiquidity in that market. What does that mean? They're defending the government bond market, meaning they're going to print money. And what's the benefactor of ongoing degradation in the money unit? Monetary metals. And now it's not just a U.S. problem or a Japanese problem or UK or Europe. It's everywhere. And any one of those you can't have turn into a crisis, because if it does, it's too big to fail. You can't have that. And so the central banks will go berserk, and gold knows this. We know we're in a different situation. Plus, we have a U.S. stock market bubble like we've never seen in history. And MSA is arguing since early this year, when S&P was 61.47, into the drop, we said it would bounce at 4,800. Sure enough, it did, and it shot to a new high by 10 or 12, 13%. And we've been laboring up here now for about 4 months in this mid-60, 6,600, 6,700, 6,800 area, just around 7,000 or lower. It's not been really gaining. It's just been hanging in there. We think that is a topping process. Just like the 2000 dot-com high, it took a year and a quarter to finally break it, okay? 2007, before you imploded into 2008, it took like a full year of laborious topping process, including with the Fed rate cut. And I think the stock market right now is probably going to see its real sharp weakness, not this year. You might get some more wobble, but it's in the first quarter of next year. And that's when suddenly a lot of other assumptions about where to be or what's likely to be the economic outcome or future are going to go out the window when that beast starts to roll over. And again, one of the first initial technical evidences of that, gold breaking out versus the S&P, is a statement. It's saying somebody's moving big money.
Combining the technical breakout captured by Maloney with the structural, macro, and supply-demand analysis from Oliver, the outlook for silver becomes profoundly bullish. This isn't a short-term pop or speculative run. It's the beginning of a sustained revaluation of a metal that has been ignored for too long. Silver is now emerging as a foundational asset, a monetary metal and an industrial commodity, bridging both roles with growing global relevance. If central banks continue to expand balance sheets, governments persist in piling up debt, and currencies remain under pressure, as seems increasingly likely, silver offers one of the few real hedges left. It is not just a commodity trade. It is a repositioning of wealth into something tangible, reliable, and historically proven. For investors who see the writing on the wall, silver could easily rise well beyond what most expect. Yes, there is risk. Nothing in markets is guaranteed, but the risk of being underexposed to what may be the defining asset of the next decade feels far greater. History shows us what happens when leverage is abused. Today, we have demand, fundamentals, and macroeconomic pressure working in favor of silver. Betting against that seems reckless. If you believe this analysis resonates, subscribe, like, share, and ring the bell. More deep dives, more data, more structural breakdowns are coming. Thank you for watching, and stay ready.